Your credit score is a big deal. It's a number that tells lenders how risky it is to loan you money. A higher score means you're more likely to get approved for loans and credit cards. Not only that, but you'll also get better interest rates. This can save you thousands of dollars over time. Think of it like this. Your credit score is your financial GPA. You want to keep it as high as possible. A good credit score opens doors. It can help you buy a car or even your dream home. You'll also qualify for lower insurance premiums. Landlords often use credit scores to screen tenants. A good score can make a difference in getting that apartment. Don't let a bad credit score hold you back. It's time to take control of your financial future. Improving your credit score takes time and effort, but it's worth it. Start by understanding what factors affect your score. Then you can take steps to improve those areas. Are you ready to start building a solid financial foundation? Let's get started. Your credit report is like a financial report card. It shows your credit history. This includes your credit accounts, payment history, and any outstanding debts. It's important to review your credit report regularly. Make sure all the information is accurate. You're entitled to a free copy from each of the 3 major credit bureaus annually. You can get your credit report from Equifax, Experian, and TransUnion. These are the 3 major credit bureaus. Order your reports online or by mail. Review each report carefully. Look for any errors or inaccuracies. Dispute any incorrect information immediately. This will help ensure your credit score is a true reflection of your financial history. Common errors include incorrect personal information. This could be an incorrect address or phone number. You might also find accounts that don't belong to you. Late payments that you know were made on time are another issue. Check for duplicate accounts as well. If you find errors, contact the credit bureau immediately. The credit bureau will investigate the dispute and correct any inaccuracies. There are many myths surrounding credit scores. Let's debunk some of the most common ones. One myth is that checking your own credit score hurts it. This is false. Checking your own score is considered a soft inquiry. This does not affect your score. Another myth is that closing old credit cards helps your score. This is also false. Closing old accounts can actually hurt your score. It can shorten your credit history and increase your credit utilization ratio. It's best to keep old accounts open, even if you don't use them often. Some people believe that carrying a small balance on your credit card helps your score. This is not true. It's best to pay your credit card balance in full each month. This shows that you're responsible with credit. It also avoids paying interest charges. Focus on making on-time payments and using credit wisely. Credit utilization is a major factor in your credit score. It refers to the amount of credit you're using compared to your total available credit. A lower credit utilization ratio is better for your score. Keep your credit utilization below 30%. This means if you have a credit limit of $10,000, you should keep your balance below $3,000. There are a few ways to lower your credit utilization ratio. One way is to pay down your credit card balances. The lower your balances, the lower your utilization ratio. Another way is to increase your credit limit. This can be done by asking your credit card issuer for a credit limit increase. Be careful not to open too many new credit accounts at once. This can hurt your credit score. Each time you apply for a new credit card, it results in a hard inquiry on your credit report. Too many hard inquiries can lower your score. By managing your credit responsibly, you can improve your credit utilization ratio. This will boost your credit score. Section 5. The impact of payment history. Your payment history is the most important factor in your credit score, accounting for about 35% of your score. It shows lenders how consistently you pay your bills on time. A history of on-time payments demonstrates that you're a responsible borrower, which can lead to better interest rates and loan terms. Conversely, late payments can negatively impact your credit score, and the later the payment, the greater the negative impact. If you're facing financial difficulties, it's crucial to contact your creditors immediately. They may be able to work with you to set up a payment plan. To avoid late payments, set up payment reminders. You can use your bank's online bill pay system, set up calendar reminders, or use a financial app. Making your bill payments on time should be a priority. It's one of the most important things you can do for your credit score. If you have any missed payments on your credit report, consider writing a goodwill letter to the creditor. Section 6. Diversifying your credit mix. Your credit mix refers to the different types of credit you have, which can include credit cards, retail cards, installment loans, and mortgages. Having a diverse credit mix can show lenders that you can manage different types of credit responsibly. A good credit mix typically includes a combination of revolving credit and installment credit. Revolving credit includes credit cards and lines of credit, while installment credit includes loans with fixed payments, such as car loans, student loans, and mortgages. If you only have one type of credit, consider adding another type. For example, if you only have credit cards, you might consider getting a small installment loan, like a small personal loan or a car loan. However, make sure you can afford the monthly payments before taking on any new debt. Focus more on making on-time payments on all your accounts and keeping your credit utilization low. Section 7. The length of credit history matters. The length of your credit history is another factor that influences your credit score. It refers to how long you've been using credit responsibly. A longer credit history is generally better for your score. It shows lenders that you have a track record of managing credit over time. Your credit history includes the age of your oldest account, the average age of all your accounts, and the age of your newest account. The longer you keep your accounts open, the more it benefits your credit history. Don't close old credit card accounts, even if you don't use them anymore. Closing old accounts can shorten your credit history and potentially lower your score. If you're new to credit, building a positive credit history takes time. Start by opening a secured credit card or becoming an authorized user on a responsible family member's account. Over time, your credit history will grow. Section 8. Avoid opening too many accounts. Opening too many new credit accounts in a short period can hurt your credit score. Each time you apply for credit, it results in a hard inquiry on your credit report. Hard inquiries can stay on your credit report for up to 2 years. Too many hard inquiries can signal to lenders that you're desperate for credit. This can make them less likely to approve your applications. It's best to only apply for credit when you need it. Before applying for any new credit, check your credit report for any errors. If you're planning to make a major purchase, such as buying a car or a house, avoid applying for new credit in the months leading up to your purchase. Multiple hard inquiries in a short period can lower your credit score. Spacing out your credit applications can minimize the impact on your credit score. Section 9. Dealing with credit card debt. Credit card debt can be a major obstacle to achieving your financial goals. High interest rates can make it difficult to pay down your balances quickly. This can lead to a cycle of debt that's hard to break free from. The first step to dealing with credit card debt is to create a budget. Track your income and expenses. Identify areas where you can cut back on spending. Put any extra money towards your credit card debt. Consider using the debt snowball method. This involves paying off your smallest debt first. Then, you roll the amount you are paying on that debt into the next smallest debt, and so on. Negotiate with your credit card companies. Call them and ask for a lower interest rate. Explain that you're trying to get out of debt. You may be surprised at how willing they are to work with you. Consider a balance transfer credit card to pay down your balance without accruing interest. Section 10. Taking control of your credit future. Taking control of your credit future is within your reach. Start by understanding the factors that affect your credit score. Make a plan to improve your credit health. This includes paying your bills on time, reducing your debt, and using credit responsibly. Remember, building a good credit history takes time and effort. Regularly review your credit report. Dispute any errors you find. Stay informed about your credit score. Check your score regularly to track your progress. Celebrate your successes along the way. Achieving a good credit score is a marathon, not a sprint. Improving your credit score can open doors to financial opportunities. Take charge of your financial future by making smart choices today.